In today's video, we're covering 5 major credit score and credit report changes that will affect millions of Americans in 2025. The first major change is that buy now, pay later companies like Afterpay or PayPal's Pay in 4 will start reporting these accounts on your credit reports. These are basically short-term loans that let you split a purchase into smaller payments over time instead of paying the full price up front. You've probably seen these options while shopping online or in stores. In the past, most of these buy now, pay later accounts weren't reported to credit bureaus, but that's now changing, and you'll soon start seeing them on your Experian, Equifax, and TransUnion credit reports. This could potentially help your credit score if you're always making on-time payments, but if you don't pay on time or frequently miss payments, it could do some serious damage to your credit score. Another downside is that adding these accounts to your credit report can lower your average credit age, which might bring your credit score down, especially if you're new to credit. These accounts on your credit report could also make it harder to qualify for a loan, car, or even a home. Lenders will see these debts now, and it might hurt your chances of getting approved or cut how much you can borrow. So if you have multiple buy now, pay later loans, or you're thinking about getting one, be careful. Unless credit bureaus change how these loans are factored into credit scores, they could end up doing more harm than good. So my advice is to pay off those loans as soon as possible before they start reporting to your credit report and mess with your score. And if you've recently made a purchase with one and you're not sure if it's being reported, remember that you can check your credit report completely for free at annualcreditreport.com. The second major change is that the Consumer Financial Protection Bureau recently came out with a new rule to ban medical debt from reporting on credit reports and prohibit lenders from using medical information when making loan decisions. Right now, Americans have over $49 billion worth of medical debt on their credit reports, usually because of unexpected hospital bills or their insurance not covering everything. So if this change actually happens, millions of people could see their credit scores increase by an average of 20 points. They expect this rule will also help about 22,000 more people get affordable mortgages each year. So more people will most likely qualify for home loans. This was announced back in January 7th, 2025, and it's expected to take effect around March 17th, 2025. However, with the Trump administration pausing all actions from the CFPB, we'll have to wait and see if this actually happens. If it does, be on the lookout and check to see if your medical bills have been removed from your credit reports. And be patient because the removal process will most likely take some time. Next, we have a huge change in mortgage lending. Usually when you apply for a mortgage, lenders pull credit reports from all 3 major credit bureaus, including Experian, Equifax, and TransUnion. This is called a tri-merge. But now Fannie Mae and Freddie Mac want to change that into a bi-merge where lenders only check 2 of the 3 reports. For example, they might pull TransUnion and Experian or Experian and Equifax, etc. On top of that, instead of using FICO scores, they want to start using a different scoring model known as Vantage Score 4.0. This could mean that a lot more people that couldn't buy a home before might be able to qualify for a home loan using the scoring model. However, this would be an optional thing for lenders. They can choose to keep using what they used before and not use Vantage 4.0. So it's not really guaranteed that all of them will use this and everything could just continue the same. This change is expected to roll out in late 2025, but again, we're going to have to wait and see how many lenders actually use it. Another major change being talked about is a possible cap on credit card interest rates. Trump has suggested limiting credit card interest rates to just 10%. That means that no matter what, banks wouldn't be able to charge you more than 10% interest on what you owe them. Right now, the average rate is around 20%, with some credit cards charging 25% in interest or more. So if this does happen, it could save people hundreds to thousands of dollars in interest. For example, if you owe $10,000 at 20% interest, you would pay an extra $2,000 in interest per year. But with a 10% cap, that drops down to just $1,000, saving you $1,000 a year. So these lower rates could potentially make it easier to pay off your credit card debt much faster. But while this could benefit borrowers, banks may lose money and might respond by lending less, especially to people with lower credit scores. Or they could increase annual fees on credit cards or even start adding sneaky charges to make up for the lost interest. All of this is still in talks though, and will need approval from Congress, so nothing is really final yet. But whether it happens or not, my advice when it comes to credit cards is simple. Only spend what you can afford to pay off before the due dates, and always pay off your credit card balances in full every month. For example, if you want to buy a $500 TV, you should have those $500 ready in your bank account. That way you can pay off your credit card balance in full that same month. If you do this correctly, you won't really have to worry about interest charges or late payment fees, unless of course something comes up and you're forced to. Plus it keeps your credit utilization low, which helps increase your credit score over time. But if you can't use a credit card properly, try not to use one unless it's a true emergency, because carrying a credit card balance you cannot pay off can get out of control really fast. Anyway, the fifth change that's been going around is that AI might soon change how credit scores are calculated. Instead of just looking at things like your loan and credit card payments, they could start looking at other things such as your rent payments, utilities, employment history, shopping habits, bank account activities, and even social media behavior to determine your credit worthiness. If this happens, it could be a total game changer. You might not need to take out a loan or get a credit card to build a good credit score. Instead, your score could go up by paying for things you might already be paying for, like your rent, utilities, or even staying at the same job for a long time. This could make it a lot easier for people to build and maintain a good credit score without having to worry about credit card or loan debt, fees, or crazy high interest rates. I mean, if you're paying your bills on time, like your rent and utilities, that should totally count, right? With that being said, the basics aren't going anywhere. Payment history, credit utilization, account age, mix, and inquiries will still matter. AI is just adding a little extra flavor to the mix. However, not everyone's a fan of this idea. Some people see it as an invasion of privacy, kind of like that social credit system thing in China, which I'm not gonna lie, creeps me out. But what do you think? Let me know in the comments. Anyway, that's going to be it for today's video. Make sure to share it with friends and family so they're aware of these changes that will most likely affect us all. If there are any updates, I'll make sure to let you guys know about them. So don't forget to like, subscribe, and turn on those post notifications so you don't miss out. And if you found value in today's video, you might also find value in my free newsletter where I talk about all things finance, including credit scores and credit cards, debt management, bank accounts, real estate, investing, and much more. You can download it by clicking the link in the description. Thanks for watching, and I'll see you guys on the next one.